welcome back everybody. We have finally reached the final segment of this morning's agenda. We usually have Steve Romick on the call, and I always apologize to him for having a graveyard shift, and he reminds me that Nedgroup are just purely saving the best for last. And on that notion, we welcome Steve's colleague Brian Selmo to the webinar this quarter. Brian, thanks for joining us.
Thanks for having me, David.
And I believe we're going to do things slightly differently to how we might have done this in the past. I know, Brian, you want to spend just a couple of minutes talking through the contrarian value equity, or CVE, as we call it in the corridors of Nedgroup Investments, just to, I guess, introduce the fund to some clients that may not be familiar with it.
Yeah, sure. And CVE, I think the best and easiest way to think about it for people who are familiar to the global flex strategy is that it is the equities that are above $5 billion that are in global flex scaled up to a fully invested portfolio. And so it's market caps of above 5 billion, somewhere between 30 and 50 names with the same long-term focus, same avoidance of permanent impairments of capital risk management. And so it's very much a congruent strategy to the global flex strategy, but it is one that is fully invested. And so we have a different investment objective. So the objective is to outperform the MSCI ACWI over time, but it's the same investment approach, and it is the same philosophy that we use in everything else that we're doing. And over the last few years, we have actually slightly underperformed the benchmark, and this is largely a result of the narrow market in the last 6 months the first 6 months of this year, which I think we'll talk about a little bit later in this presentation. And so now maybe back to the global flex update.
Yeah, that was perfect. Yeah, thanks, Brian. I think we got a good sense of the fund and what it means as no pure carve out, but there's obviously larger cap stocks that would find themselves in global flex, and this is more our comfort zone, talking about global flex for now, at least mine anyway. How do you feel the fund has performed relative to that performance indicator to the 30th of June this year?
Yeah, considering the narrowness of the market, I think it's been reasonable, but it's been slightly behind the market or the performance indicators year to date, as you can see on this slide. And then on the longer 1 and 3 and 5 year periods, it's continued to outperform the indicator.
And then in terms of the contribution side, would you highlight, I guess, some of the investments that have proven to be meaningful in the fund's trading 12-month performance?
Yeah, you can see that the top 5 and bottom 5 contributors and detractors, and the top 5 have contributed 8.7%, and the detractors have, detracted by 2.7. And I'll talk about a little bit of the yin and yang, I suppose. On the performance contributor side, Analog Devices, which we've owned since 2011, is an analog semiconductor company, and it's benefited from the build out in AI data centers and also general enthusiasm for semiconductors. On the other side of that, Nintendo has been a detractor, and while its core gaming business has continued to perform well, people are concerned that they will have cost pressure given the extreme price increase in memory chips over the last, say, 6 to 12 months.
Thanks, Brian. I know when we think about asset class composition, I always enjoy your slide to show how it's tilted and changed through the quarters and the years, and it really gives us a nice lens into your view of the investment universe, for that matter. Some changes quite noticeable, I guess, from 1 year ago and today. I mean, just looking at, for example, bonds been trimmed a fair bit, you got cash, and then just a number of equity positions have risen as well. Any other notable changes that you think we should take note from this slide?
No, I think we'll talk about the notable changes have been happening below the water level. And so you mentioned the increase in the number of holdings. So the equities have increased a little bit. Cash has decreased a little bit, even considering that reduction in bonds. And it's really a story of finding a number of new positions that are largely, in our mind, AI agnostic. And these are mid-cap companies on a global basis. And so you've seen a number of new positions in the portfolio, including 4 new positions this quarter and increasing 7, while exiting 4 positions and trimming 13, largely on the basis of valuation in terms of those reductions.
Thanks, Brian. Before we welcome you on the webinar, we've spoken to our global equity managers, our emerging market, bonds, other multi-asset class fund managers as well. And there were quite interesting observations around different regions and different sectors. Is there a particular region or sector that's sticking out for yourselves?
There's not a particular region or sector. We're finding actually, quite broad, scattering in terms of country, domicile, and even sectors in terms of the names that we've been buying. The one thing that I think does sort of shine through is just the, underexposure to bonds. And there's a reasonable, level of concern around inflation and the durability of inflation. And so that's been that coupled with narrow credit spreads has really reduced our appetite there and accounts for a large portion of the cash holding.
Thanks, Brian. And I mean, a lot of those folks that have dialed in, we get a lot of news and headlines around increased nationalistic politics around the world, but globalization is still quite entrenched in many of our systems here. So in terms of the equity and the geographic composition of it, it's no longer just a case of looking at where a company is domiciled, but where that revenue is coming from. Is that a fair way that we should be looking at the regional sort of composition of the fund?
Yeah, and that's long been our focus, is really to look through to where the businesses generate revenue, profitability, have economic gravity, and so the portfolio continues to be highly global from a diversification of the revenue and profitability, and you can see that on the right side here, and those exposures have not changed meaningfully over the last 6 or 12 months.
Okay, interesting to note. Thanks, Brian. We're now moving on to the concept of a narrow market, which you brought up earlier in today's presentation. What a fascinating infographic you have on the right-hand side there. Maybe you could speak to the broad market and its narrowness. I mean, visually, as I see that, looks like Microsoft is the diesel engine, which is probably not a great analogy. They're obviously a company that keeps managing to reinvent and reimagine themselves and keep up with where trends are. I'm not sure, what comments do you have here in terms of this narrowness that you're seeing and how are FPA thinking about it?
Yeah, I would we call this out just for maybe situational awareness if some people don't, follow market composition, day to day, month to month. So in terms of the top 10 names in the index, it's the sort of largest share that they've been in the past, say, 40, 50 years. And I think what we're pointing out on the as I look at it, right side, is that the largest businesses tend not to remain, in terms of market cap, tend not to hold that position over time, right? The nature of competition and evolution, being what it is. And so, it's an interesting situation that, most people have not had a appreciable amount of time living through, where you've got, a small handful of companies really driving what in quotes is, the market, where it's maybe more of, at this point, a particular theme. And I think if we go on and look maybe at the next slide, where we sort of point out what the tech hardware component of the market has become. Again, this is up at around 30% and the largest share that it's been, recorded in the past. And so, again, that's a notion that the market is fairly focused on one theme, and the theme, of course, and this is JP Morgan's take, that the theme is, it's AI. And whether it's the models or whether it's the build out and the infrastructure, JP Morgan thinks it's about 50% of the index. And so that to our mind is a fairly, narrow market in terms of what's driving, performance and news and whatever else. It's also driving a lot of economic activity. So it's certainly a very real phenomenon, but it is, kind of one note that's being played.
Mm. Your next slide has a common theme to it as well on that AI component. So just that, how these companies within the S&P, now looking at 41 stocks making up, like you say, north of 40%. I mean, it's quite eye-watering when you look at the slides and the line charts from this perspective. Is there anything else here that stands out for you in this?
No, I think that the other side of it is kind of, where the opportunity is. And so I would say that the opportunity from our eye is kind of at everything else, right? There are a lot of, maybe ignored or underappreciated businesses that are very high quality, that have strong market positions, strong industry positions, good management teams, but aren't direct beneficiaries of the theme that is driving the market. And that's where we've found a number of new positions over the last 18 months or so. And so I think earlier you mentioned that there's an increase in the number of names in the portfolio, and there very much are. And so there's kind of two counterbalancing forces going on. One is we've been buying a bunch of smaller and mid-cap companies that are domiciled all over the world, and have been selling and reducing companies where the valuation has gotten a little bit more stretched, and the questions that one has to answer to be comfortable with the prospects over the medium to long term feel a bit more difficult or a bit more narrow.
I must say, when I saw your slide with an animation of a duck there, I immediately anchored on that old saying, to be more like a duck, i.e. calm on the surface, but paddling furiously underneath. But I think this is a different analogy you're looking for here. This is around the broad opportunity set that's available to active managers that might be a little bit below the surface that we might expect in the AI game.
Yeah, that's right. And we're also sort of alluding to the notion that, well, the overall portfolio that we looked at in terms of exposures earlier has remained fairly similar. There's actually been quite a lot of activity going on beneath the surface. And so this sort of just is I think a fun picture, and then just the sort of a rundown of the activity that's gone on the last 18 months or so, 2 years. And so what's interesting about these, maybe if we go to the next slide to us, is this is a sort of a Venn diagram to us of, businesses that are below 15 billion in market cap in green, and then domestic US on the right side and international domicile on the left side. So I think it gives a sense of, a very broad opportunity set around the globe. There's no one concentration in industry. And certainly if there's a theme to it, it is in these more mid-cap sized companies. And so we've seen the, medium market cap in the portfolio come down a bit. And we've been able to buy these businesses at, valuations that we think are fairly compelling, purchase somewhere between 10 and 15 times earnings for the most part. And while they're significantly smaller than the index, the purchases are, the businesses are industry leaders, strong balance sheets, attractive growth profiles. And I think interestingly, based on, street estimates at the overall portfolio level, so, averaging everything out, the expected growth in earnings of our portfolio has increased over the last year, given these changes. And that's while staying at kind of the same valuation level as where we've kind of been in the past, and certainly were a year ago. So that's kind of the activity that's been going on in the last little bit, and that's kind of how we see the market today.
Thanks, Brian. I was going to ask you about everything and all the context you've given us, how they might fit into the way that the portfolio is positioned. But I think, this diagram and specifically the way that you articulated really captures that quite nicely. And I think a nice point to end there. And I think the investors have got a good sense of where your diversification is across not just regional as well, but the market cap scale. So Brian, thanks for joining us today.
Thanks, David. Appreciate it, and appreciate the long-term partnership.
No, an absolute pleasure.